Your retirement account just lost nearly 30% of its real value. Overnight, did you notice, not because stocks crashed? No, not at all. In 2025, the S&P 500 still rose about 16% in price, close to 18% including dividends. But when measured against the true yardstick, gold, you suffered a heavy loss. Gold surged nearly 67% that same year. Quick math, your portfolio up 18% gold, up more than triple that rate. In gold terms, you actually lost around 29%. That is no typo. That is the hidden cost of living in a system where money can be printed without limit. And this is no ordinary weakening. The US dollar is undergoing a profound revaluation. The dollar index fell about 10% in the year. Against gold alone, its purchasing power eroded by nearly 40%. Meanwhile, the central banks, the very creators of fiat money, bought gold at near record levels since 2022. More than 860 tons just in 2025. Ray Dalio calls this capital war, not just trade war, a struggle where money itself becomes the weapon. Nations compete for capital flows, payment control, and system dominance. What is at risk? Almost everything priced in dollars. Your retirement account, your savings, your daily purchasing power, even your wages. By the end of this talk, you will understand what is happening, why the system operators cannot reverse it, and what you can do now to protect yourself and your family before things get worse. Pause and think for a moment. The dollar is losing value, and most people do not even realize it. They still measure everything in dollars, like using a ruler that shrinks every month, then celebrating because you appear taller. In 2025, the dollar weakened significantly against major currencies. The broad dollar index dropped about 10%. But gold gives the clearest, most honest signal. You cannot print it. It needs no central bank press conference. It simply reports the true state of your currency. Your real life depends on purchasing power. Your salary is not just a number. It buys energy, food, housing, healthcare, and precious time. When the unit you earn in keeps getting diluted, you work harder yet fall further behind. I am not saying the dollar vanishes tomorrow. It remains the backbone of global finance. But dominance does not equal absolute safety. History shows debt-heavy empires often devalue their currency to handle obligations they cannot meet openly. As Ray Dalio has stressed, gold is the base money. Love him or not, he understands big cycles. When he warns America is entering a debt vortex, the meaning is simple. Mathematics is now overriding politics. U.S. public debt stands at roughly $38.6 trillion, an official number updated daily, not speculation. In this volatile year of 2025, listening to deep insights from legendary investors like Warren Buffett matters more than ever.
Their clear views on real value versus nominal growth are the key to avoiding the system's illusions.
Miss these perspectives now and you may lose the chance to adjust your strategy before bigger shifts arrive. And it is precisely the speed of this debt growth that should make you sit up and pay attention. In 2025, U.S. public debt jumped from $37 trillion to $38 trillion in just over 70 days. In other words, at the current pace, debt rises by billions of dollars every single day. Debt itself is not the monster. The real monster is what happens when debt starts feeding itself. This is a deadly spiral, plain and simple. You borrow to cover budget deficits. Interest costs rise. You borrow more to pay the higher interest. Markets see greater risk and demand higher yields. Interest costs climb again. Eventually, the system runs out of funds. To support new programs, it only services old debt. People call this the debt spiral. Net interest on the debt reached nearly $1 trillion in fiscal year 2025, roughly equal to defense spending at times. And every dollar spent on interest creates nothing new. It builds no roads. It funds no factories. It educates no children. It invents no breakthroughs. It simply pays yesterday's promises. So why not fix it? Option one, raise taxes sharply. Try it and watch capital vanish like magic. Money has no loyalty. It moves to friendlier places. Option two, cut spending deeply. Pick your favorite sacred cow. Social Security, Medicare, defense interest, then announce the cuts. That is no longer economic debate. It is career-ending politics. Option three, devalue the currency, inflate quietly, make tomorrow's dollar weaker. So yesterday's debt becomes easier to pay. And here is the uncomfortable truth. Those three paths lead to four familiar outcomes that every high debt cycle eventually faces: restructuring, outright default, severe austerity, or currency devaluation. The United States will not voluntarily default. In the classic sense, austerity on the needed scale would trigger massive political backlash. Restructuring is just default with a nicer name. So the path of least political pain tilts towards some form of quiet devaluation. It silently spreads the cost to everyone holding the currency. That is the structural trap, not cartoon villain evil.
Just natural incentives.
When debt grows this enormous, the easiest road is financial repression. Interest rates below inflation, gradual currency loss, and policies that push savings into government bonds. That is why official inflation numbers often feel like a joke to most people. Your life is not a CPI basket. It is skyrocketing, rent rising, food prices, expensive insurance, child care costs, and the struggle to buy assets before they slip away. Moreover, inflation does not show only on price tags. It appears first in asset prices. Stocks, real estate, scarce assets, they absorb excess liquidity ahead of everything else. That is why the economy can look fine on paper, while your personal upward mobility feels worse every year. New money does not spread evenly. It flows to financial assets first. Wages come last. So cheering record stock highs is often just an illusion. If the measuring stick keeps weakening, nominal prices must rise just to hold real value steady. The S&P index can post a strong dollar gain in a year, but in real terms you are poorer, especially if your true yardstick is global purchasing power over decades. 2025 proved this clearly. A great year for stocks and nominal dollars. A terrible year for stocks measured in gold. And when someone says, my retirement fund is up big, I do not dispute the number. I question the ruler. If your fund rises 18% while the currency loses 40% against gold, that is not wealth creation. That is sprinting on a treadmill that keeps speeding up. In this turbulent financial year, absorbing sharp insights from masters like Warren Buffett is more urgent than ever. Their reminders about real value versus surface growth serve as a guiding light. To avoid getting lost in illusory numbers, ignoring them now means missing the chance to adjust before larger shifts arrive. And now let us face the refinancing wall head on. This is the moment when the debt spiral turns from theory into a pressing timing issue. In 2025, about $9.22 trillion in Treasury bonds matured and had to be rolled over. In 2026, another $9 trillion is set to mature. This means the United States is not just funding new deficits. It is constantly refinancing massive old debt as well, when current interest rates are much higher than when that debt was first issued. Refinancing becomes an enormous burden. Cheap old debt expires, expensive new debt takes its place, interest costs rise again. And the familiar loop returns: cut spending, raise taxes, or devalue the currency. That is exactly why policymakers obsess over bond yields. Not because they love low rates, but because low rates are the oxygen keeping this highly leveraged system alive. And markets can turn frightening very quickly. The government may cut policy rates to cool things down, but if markets sense worsening financial or political reality, they can still demand a higher risk premium. You can lower the thermostat inside the house, yet the fire in the backyard can still flare up. Now the story grows even more uncomfortable. The world is gradually diversifying away from dollar assets, at the margin step by step, not because the dollar is about to disappear, but because the assumption of risk-free safety is no longer sacred as it once was. The dollar remains the dominant reserve currency. According to the Federal Reserve in 2024, it accounted for about 58% of disclosed global official reserves, down significantly from much higher levels decades ago. IMF data shows the dollar share hovering around the mid-50s, with shifts often driven by exchange rates. But the long-term trend is clear diversification toward other currencies and assets. At the same time, gold is quietly reclaiming its central role. The European Central Bank noted that by 2024, gold had become the world's second largest reserve asset, by market value trailing only the US dollar, thanks to rising prices and strong central bank buying. Let that sink in for a moment. Gold, once dismissed as outdated in modern textbooks, is steadily returning to a core position. The purchases are substantial. World Gold Council figures reported by Reuters show central banks bought a net 863 tons of gold in 2025 alone. Global mine production that year was about 3,672 tons. So central banks absorbed nearly 1/4 of the new annual physical gold supply. Not a trivial amount, a meaningful slice of the real physical market. And if you ever wondered why gold moves so sharply, this is a big part of the answer. Who is buying and why? Motives matter deeply. Poland has lifted its gold allocation to around 28%. China has continued steady monthly additions in recent years, while gradually reducing treasury holdings, down more than 10% since early 2025. According to Reuters, does this mean everyone is dumping treasuries? Not at all. Foreign holdings of treasuries actually hit an all-time high by the end of 2025. But marginal behavior is shifting noticeably. More gold accumulation, more experiments with alternative payments, stronger hedging against political and geopolitical risks, and at the deepest level, counterparty risk. When you hold treasuries, you are making a double bet. The US government will repay in dollars, and those dollars will hold their real purchasing power over time. In this uncertain global financial landscape of this year, continuing to absorb sharp insights from masters like Warren Buffett is not merely helpful, it is truly essential. Their warnings about real value, the fragility of fiat trust, and how large debt cycles ultimately resolve serve as a steady compass amid short-term illusions. Overlooking them now means leaving yourself exposed to shifts that are unfolding day by day. And when it comes to gold, do not overlook the mining sector, a completely different field. It offers higher growth potential in bull markets, but comes with operational risks, legal risk, cost inflation, and sharp commodity and stock volatility. There is no free lunch anywhere. Only clear trade-offs, and yes, secure storage truly matters, not because the world is ending, but because treating insurance like a casino chip defeats its entire purpose. For most people, a properly insured safe deposit box at a bank or trusted facility is far more practical than hiding it in a shoebox under the bed. The goal is long-term resilience, not a Hollywood bank heist scenario. What about Bitcoin and cryptocurrencies? They exist. They have seen explosive rallies and brutal drawdowns. They remain young compared to gold's millennia-long history and carry their own regulatory and technological risks. Some view them as systemic hedges. Others see them as bets on breakthrough technology. The issue is not worship or outright rejection. The issue is caution. High volatility does not equal true safety. And here is the trap most people fall into. They hear this and immediately think, okay, I will just buy international stocks that can help somewhat. But it is no magic fix. Europe grapples with its own debt burdens. Japan has endured decades of debt cycles and deflation. Emerging markets face their own currency risks. Geographic diversification is useful, but the same global forces, mounting debt, aging demographics, energy constraints, geopolitical tension, affect every region. So the real question is not where to diversify, but where is the actual money flowing? And when you follow the money flows, you see policy priorities. Long before official speeches announce them, when debt service costs soar, governments seek relief measures. They blend growth, hard to achieve, inflation easier to generate, and financial repression, the quietest path. Financial repression means rules and incentives. To keep capital domestic, keep savings in the banking system, and keep borrowing costs manageable. That is why you see renewed interest in policies that sound kind and simple, yet produce uncomfortable side effects. Credit controls do not eliminate risk. They shift it to someone else. Banks tighten lending standards. Those who need credit most get cut first. Once again, not politics, but mechanics. So if you are following all this and wondering, where is the opportunity? Here it is. You can position yourself before the crowd realizes the game has changed. Most people still act like it is 2010 or 2021. Buy the dip, rates fall, liquidity saves everything. Stocks only go up. Cash is trash. Bonds are safe. That regime is no longer guaranteed. In a world of capital war and major debt restructuring, the skill is not just picking the best asset. The skill is building a portfolio that survives multiple scenarios. Persistent inflation, slowing growth despite lower inflation, rate cuts paired with currency weakness, or spiking risk premiums as markets demand compensation for chaos. That means you do not need one perfect investment. You need a solid structure, businesses with durable, high-quality cash flows, protection against inflation and currency risk, liquidity to avoid forced selling at the worst moments, and clear rules so emotions do not betray you when markets boil or panic. Now look at one more piece of data that confirms the new regime. Gold is not just being bought by central banks. Investment demand surged in 2025 with heavy inflows into gold-backed ETFs, and total gold demand hit record levels. Per World Gold Council data, this shows it is no longer just a government story. It is becoming a genuine portfolio story. And that sets the stage for what happened recently on January 24th and 26th, 2026. Reuters reported the U.S. government backed about $1.6 billion in debt and equity financing for USA Rare Earth, including a 10% stake to develop a domestic rare earth mine and magnet factory. In plain terms, Washington is putting real money into strategic supply chains tied to national security. Rare earths magnets, critical minerals, essential for defense systems, advanced electronics, electric vehicle motors, and industrial platforms. This is not random. This is capital war behavior. When the world feels divided, nations do not just talk resilience. They fund it, subsidize it, and pour capital into strategic sectors, because controlling resources means controlling leverage. So if you think this is only about gold, you are missing the much bigger picture. Gold is the clearest signal, but critical materials, energy, and domestic industrial capacity are the real battleground. For your portfolio, that implies two key lessons. First, stop assuming software and mega cap stocks are eternal winners. There are cycles where real assets and the companies that produce them get powerfully re-rated, especially when governments actively reshore production and reduce reliance on geopolitical rivals. Second, stop assuming government action always hurts markets. Sometimes it becomes a powerful tailwind, especially for sectors aligned with national priorities. The key is distinguishing between your political wishes and what capital is actually doing. If your portfolio grows in nominal dollars, but you cannot afford more gold, more fuel, or several months of living expenses, you have not built real wealth. You are just chasing a moving target. Never underestimate the psychological side. The system trains you to celebrate small wins because they feel good immediately. True wealth whispers more quietly. It feels boring. True wealth is waking up and realizing you do not need the system's permission to feel financially secure. The goal is not to become an extremist or oppose any country. The goal is realism and clarity. In a world drowning in debt, policymakers are trapped between present pain and future pain. They usually choose to delay the pain and mask it through currency. When you see that clearly, you stop being shocked. You respond like an adult, not like a victim. None of this is personalized financial advice. I do not know your situation. I am simply offering a framework so you can ask sharper questions and make better decisions. But if you remember only one thing, remember this: your portfolio does not just need diversification by stock or sector. It needs diversification across financial regimes. It needs protection against the possibility that safe dollar assets are only safe in name, but vulnerable in real purchasing power. So what comes next? In practice, start tracking reality, not illusion. Check your dollar exposure. Build insurance you truly understand. Focus on cash flow quality. Maintain liquidity. Stop chasing noise. And position early before the crowd panics and buys protection when it has become expensive. In this turbulent and deeply shifting financial year, continuing to absorb profound insights from masters like Warren Buffett is not optional. It is essential for survival. They're reminders about real value, the hidden risks in blind faith, and how to build portfolios that endure major cycles, serve as a guiding beacon through waves of illusion and panic. Missing them now means willingly stepping into a passive position as major changes unfold day by day.